Meantime, though, with 314 Research co-founder Warren Pies. Warren, it's great to have you on. I do more broadly want to get your thoughts on the market here and what Mike was just talking about, which is the fact that you do have an S&P that looks like, and parts of the market that look like they are in deeply oversold territory. Are you expecting a rebound from here? What would you be watching for to know that it's actually truly taking root in a meaningful way?
Yeah, I think Mike set the table, as he always does, really well there. In my view, the market, it's a tale of two markets. You have the mega caps that have held the market up, S&P up double digits, and under the surface, though, it's pretty bad. Russell 2000 is now down for the year. Equal weighted S&P is down for the year. Micro caps down a lot for the year. So there's a major divergence between these big cap tech stocks and big cap stocks in general and the rest of the market. And this goes right back to where we were at the beginning of really June. And that was when we saw this original divergence between big cap stocks and the rest of the market. And what you need to see for higher overall equity prices here, I think, is number one, obviously, these big cap stocks need to hold their levels, but the rest of the market has to participate. So we're looking for breadth. That's what we would call it, is we need to see breadth improve here if we're going to get a sustainable move higher in Q4. If it gun to my head, I would say I don't expect that because of what's happened in the rates market. I think the rates market on the long end moving up has really been damaging to the fundamental story for the rest of the market. So to me, I'm hard pressed to see how we get significantly higher equity prices without the rest, I'd say the bottom 490 stocks in this rate environment. So you need the perfect storm of rates coming down, the rest of the market participating.
Okay.
It doesn't look likely to me.
Okay. I mean, the Russell 2000 was the one average that kind of eked out a little bit of a gain here today. Just listening to what you're saying and knowing that you have shifted in terms of your investment calls just recently, what does that mean for the bond market? Do you like treasuries here?
Yeah, so when we started the second half of the year, when we looked out at the broad asset market, we thought that bonds were the most overvalued asset on the menu and mispriced, and we thought that commodities were the most undervalued. So we were kind of playing that long commodity and underweight bond trade. And within the last few weeks, I think value has reemerged in the bond space. So we've pushed a lot of chips back into fixed income. We're now market weight. We were significantly like max underweight. Now we're market weight bonds, and we've come out of that commodity trade. And so that was within the last 2 weeks that we made that move. And really, I mean, there's still a lot of stuff to not like: the deficit, fiscal spending, all these things we've talked about on this show before on the fixed income side. But the bottom line is there are no bad assets, only bad prices. And I think you're getting a better price here when you look at bonds from a number of different angles. We're in fair value, I think. Okay. And so that's where we're going. So
what are those angles? And I ask that because where we've seen the dramatic move in Treasury yields and the sell-off in prices of those Treasuries has been the longer end of the curve, right? It's been 10 and 30-year bonds. If you actually look at some of the short-term bonds, for example, the 2-year, the yield on that hasn't really risen. It's something like 5.05% versus 5.03% a month ago. So is it the long end that you're targeting?
Yeah, we've been moving into duration. So, 5 to 10 years out is what I think looks attractive here. 10-year yield, just take that for example. Based on nominal GDP, I think that fair value is about 5%. We were at 3.8% just like, a few months ago. So here we are basically back to what I would call fair value based on nominal GDP. And if you look at the Fed funds rate and you assume a 3% terminal rate, that basically puts us again at fair value on the 10-year. So on a spread analysis on nominal GDP, I think we're at fair value for the 10-year. Yeah, there's a lot of supply. I doubt that we've, seen the high end yields for this year, but you're getting paid for taking that risk here. And it makes so much more sense compared to just the beginning of the second half.